Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. We're on a little bit of a break. We'll be back tomorrow, of course, with the live closing beat. But this week, what we've been working on so far is just talking about active trades. For those of you that are maybe a little bit more active, you like to use your outside accounts to maybe buy and sell a little bit more. We're trying to help give you some ideas, different strategies, tips, and tricks that we can along the way. And so the way this usually works is a lot of people come to us and they say, Dustin, you manage the retirement account. It gets in my way. It's a whole different way of thinking. But I like to pick stocks. I like to be involved in the markets. I'm sort of interested in the process. And so I'm going to try to help you out with something interesting today. It's called a pairs trade. Now, I've seen this done wrong so many times on YouTube with people that have the best of intentions but don't quite understand exactly how it works. Now, I'm going to start by using one word, and then I'm going to follow up with this throughout the video. But the name of the game with a pairs trade is you want a neutral trade, right? It sounds a little bit funny, like why would you want to be neutral? You don't want something to go up or down. You really want nothing to happen. We're trying to capture the spread. A pairs trade is simply buying something and shorting something else, and you're hoping for the difference to sort of catch up and make the spread in between. So you're going to lose on one, you're going to gain on the other. Doesn't really matter which one you win on or which one you lose on. You just hope that whatever you profit is more than the loss on the other trade. So there's a couple really key sticking points here that people get wrong all the time. Now this actually stems back into like the mid 80s into the 90s when the name of, now I'm not pretending I was around at that time. I was just a little thing at that time, but I'm fascinated by studying this stuff. So in the mid 80s and 90s, the concept was less about guessing the direction and more about arbitrage. So a really simple example of arbitrage would be like the people you see on YouTube that go to the dollar store, they buy something for $1, they try to sell it online for $3 or $4, or they find something at a thrift shop that's cheaper and they try to sell it online where they can make a larger profit. They're capturing that spread between what they could buy it for and what they're going to sell it for. There's really no gain in value being made there. It's just the difference between what someone can buy it for and what someone's willing to sell it for. In the markets, a real simple example would be gold. Maybe this is not simple, but so think about it this way. If you wanted to buy gold, what would you use to buy gold? You'd use US dollars to buy gold. Well, what happens if you bought gold in a different currency and sold it in a different currency? Could you capture the spread? Is there a difference in value because the currency exchange rate has some sort of a spread there? So that would be the arbitrage. And with computers getting popular in the mid 80s and into the 90s there, it became a game of where can we capture that spread? Let's quit betting on stocks going up or down and let's focus more on the spread. Let's buy gold in US dollar terms and then try to sell it in yen, right? Or sell it in Aussie dollar terms or something like that. And because you could do that with a click of a button, it became more interesting. And so all throughout the mid 80s and into the early 90s, there were all kinds of different strategies there, a lot of scams, by the way, but there were a lot of strategies in there where people were saying, let's try to figure something out here. What's something unique we can do? I vividly remember being at the airport when I was a kid, and my family worked for the airline, so I got to fly for free wherever I wanted. As long as there was a seat available, I could say I'd like to sit on that plane and go there. Well, when you look at a can, you know how it says the states where they'll give you a nickel or a dime to turn in the can. What I always thought of as a kid, I was like 7 years old, I would look at the can and go, I could fly to Iowa for free. They'll give me 10 cents for this can. So if I smashed up a bunch of cans and stuffed them into a suitcase, could I make enough money by flying to Iowa, cashing in a bunch of cans, and then flying back since I can fly for free? So that was my sort of early childhood arbitrage thing. But today we're talking about pairs trades. Again, the concept here is neutral. Now, what you do is you look for a pair of stocks, a pair of indices, a pair of sector ETFs, whatever it may be, that are currently trading a little out of whack. They're normally relatively correlated, meaning they move together, but something has happened where one's temporarily going in the opposite direction. Could be news event, earnings, who knows what it may be. Now, you accept that you're going to buy one, short one, and you will lose on one of those trades. It's just the nature of the beast here. Now, again, the goal is to be neutral here. So I'm going to use the example that we all probably would understand, Home Depot and Lowe's. You get that they both kind of do the same thing. If they took the Lowe's logo off and put the Home Depot logo on, change the colors, you know you're going to go there and get the same thing you can get at Lowe's. Right? So whether it's a Lowe's or Home Depot, it's the same thing. Those stocks in the stock market are highly, highly correlated. When the economy does weak, Home Depot performs badly, and so does Lowe's. Well, sometimes they spread apart. Sometimes there's a little bit of a disconnect in that correlation, and that would be the opportune time to put on a spread trade. I've got an example for you here recently when Lowe's sort of disconnected from the correlation between Home Depot and Lowe's. So you can see most of the time they move together, everything is fine, but every now and then one of them spreads apart from that correlation. And so that's your opportunity to put on a pairs trade if it's something you're interested in. In this case, what you would want to do is be long Lowe's and short Home Depot. You're always going to be long the underperformer or the weaker one, and you're going to be short the stronger one. Sounds counterintuitive, but this is how it works. What you're hoping for here is that eventually either Home Depot comes down and correlates again with Lowe's, or that Lowe's catches up and the correlation continues as it did here shortly thereafter, becoming sort of spread apart. Now this happens because people put on these spread trades, very popular trade when things like this happen. There are actually scanners you can set that automatically tell you when things like this happen, and you can place these trades. Here's where people get this wrong. You want to be neutral, so you can't simply say, I would like to buy 100 shares of Lowe's and I'd like to short 100 shares of Home Depot. You're not technically neutral from a notional value, meaning the value of Home Depot would be a lot more, be more capital to put up than it would cost to put up for Lowe's. So you want to get those numbers as equal as possible. In other words, you want the same dollar amounts to be in one versus the other. You don't want the dollar amounts to be skewed. Well, if you bought 100 shares of Lowe's as where it's currently trading at right now, about 100 bucks, you would put up $10,000. So let's go to the thing real quick here and just write this out. If you bought 100 shares of Lowe's at about $100, you'd be in it for about $10,000. All margin aside for right now. I know this is not technically accurate. We'll just pretend you don't have margin. You have to have margin to short, but separate video, right? All right, so this is Lowe's, right? You've got $10,000 in it. If you bought 100 shares of Home Depot, where it's currently trading at, you'd be at about 20,500, somewhere in there. Home Depot's trade is technically bigger than Lowe's. So what this works out to be is you really need about 49 shares. And actually, let's just start over here because you're shorting Home Depot. So what you really need is 100 shares long of Lowe's, and you need to be short about 49, you could say 50, whatever, shares of Home Depot. Now what you have is about $10,000 put into Lowe's and about $10,000 short on Home Depot, just from a pure notional value. Again, no margin, just keep all that aside here for a second. The concept here is they're disconnected. The chart I just showed you, Home Depot and Lowe's, technically for the moment they're disconnected. You want either Lowe's to catch up to Home Depot or Home Depot to fall down to Lowe's. Now think about it. You're going to lose. If that happens, one of those trades is going to be negative. The other one's going to be positive. But that correlation between the two, as they come back tight again, you'll have a greater profit on one versus, or the goal is to have a greater profit on one versus the loss that you have on the other one, okay? So if you don't trade them evenly, you're going to end up where, let's say you bought or shorted 100 shares of the Home Depot, and Home Depot ends up going higher, and Lowe's catches up to Home Depot. The correlation tightens back up again. They end up moving together. You could end up with a larger loss on Home Depot than you did on Lowe's by twice as much, right? You might not even be able to play catch up there. So again, the goal is to be neutral here. Now, if you're going to use options, it's a little bit trickier here in this case, assuming that you're using at-the-money puts and calls. So you've got 100 shares long of Lowe's. You're going to actually need to, let's say, sell 2 puts at the money for Lowe's. I know this is maybe a little bit out there, but you're going to need to sell 2 puts so that you can then sell 1 call of Home Depot, right? At the money, of course. And then that would technically be as close to a pairs trade as you could be if you happen to want to do that sort of thing there. In this case, like I said, you're hoping that either Home Depot falls and Lowe's continues doing what it's doing, or you're hoping that Lowe's goes up and Home Depot starts to sort of, trade the way it has been anyways. Best case scenario, Home Depot gets some good or bad news and falls, and Lowe's ends up trading a little bit higher, and then you'll make a wider spread between the two. So that's a pairs trade in its really simplest form. There's a lot more to it, but you get the idea. The most important part there is that you want to be notionally equal. Meaning you want the dollar amount that you put up to the trade to be equal. It takes a little bit of math. You have to do a little calculation there. It just works out that this one's about half because of the current pricing there. And at some point, like you see on this chart here, Lowe's actually ends up playing the game. You're losing on Home Depot at this very moment if you're participating in this trade, but you're profiting from Lowe's. And because it's even, as these two start to become more correlated, that's where you're going to make that little spread. It's not going to be a lot, right? And when you're done with the trade, you're actually going to buy back Home Depot and you're going to sell Lowe's at the exact same time. So if you happen to have like an active trading platform, what happens is you can actually link the two together. You could tell the platform, I want this to be considered a pairs trade. And it will show you the net profit between the two. And that's what you're looking for. You're looking for a net profit between the two. You'll take the loss, you'll take the profit on one trade, and you'll have that little spread in between there. So just kind of a different way to think about it. You could do this with anything, by the way. You could do it with the indices when they get a little bit disconnected. You've heard me say the days where we're talking where the Dow's a little bit off from the S&P or the NASDAQ's off from the Dow or the S&P or whatever. You could do it with sector ETFs when you have highly correlated sectors. You could do it with bond ETFs as well. You could do it with individual stocks. As long as they're highly correlated, you can look this stuff up. It's all sort of public record. And that's a pairs trade. So let me know what you think in the comments below. Did I mess something up? Did I say something wrong maybe? Let me know in the comments there. But if it's something that's interesting to you, are we going down the right path? I like to cover sort of different things every now and then. So it's not all retirement based or stock market based. Gives you ideas of things that you can consider when you're out there shopping for trades and things you may find interesting. Hope it helps you. We'll be back tomorrow with a live closing beat. We'll do things like we normally do, and we'll see you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.